Hello, in this video, I would like to talk about cash flow statement of Apple. First, I will click on this cell again, view, freeze panes, and I would like to see the headings like this. So now I click on net income, control shift right arrow to go all the way to the end. I'm looking at right now last 12 months data ending June 27th. So you can see that the net income of Apple here for this year is $58.4 billion, which is impressive, a lot of cash generated from net income. However, net income considers depreciation amortization as a negative item because it shows a cost. However, that's not a real cash flow. It is an accounting measure to account for depreciation of the assets. So that's why this number has to be added back to net income. And you can see that it will be added later on over here, cash flow operations. So maybe if I step back, cash flow statement includes cash from operations, one, two, cash from investing. That's the second component. Again, cash from operations, the first one, and cash from investing, second one, and finally cash from financing. So if you look at it, cash from financing is $86 billion negative. And if you look at it here, cash from investing is negative $10.6 billion. However, cash from operations is a positive number of $80 billion. Again, this $80 billion includes several things, such as net income, again, plus depreciation, amortization. And then you can see that we need to add some stock-based compensation, which we show as an expenditure in our income statement. However, this is not a real cash expenditure. It is actually, it is a real cost, but it's not really like companies writing a check. Instead, companies giving stocks. And you can see that here other line items. I'm not going to go into so details, but for example, you can see that receivables looks like increase, so that we have negative 3.6 billion there. Inventories increase, so another 0.7 billion there. Account payable basically increase as well. That's a positive cash flow for us, $7 billion. And if you add them all up, this shows us here the cash from operations for Apple is $80 billion of cash is generated. However, company has to spend capital expenditures. Looks like last 12 months, Apple spent $8.3 billion. And we can see that there are some cash acquisitions here. There sale of purchase of intangible assets, and so I'm not going to go into details again, but you can see that company literally spent $10.6 billion, most of which comes from capital expenditures, cash from investing. So 80 billion from operations, and now minus 10 billion, it's like 70 billion or so left over. Plus, we need to look at now the cash flow from financing. We can see here the total debt issued. Company Apple issued new debt of $22.7 billion. That's a positive cash flow because when we issue new debt, basically we owe more money, but in exchange we get more cash. But at the same 12 months, Apple paid $19.8 billion of debt. So the net is really around $3 billion. You can see these two numbers. And then we can see that company issued new common stocks of $0.8 billion right here. And actually company bought so much common stock. That's beautiful for investors because when companies buy back their own shares, there are less number of shares outstanding. That means that we make more profit per share outstanding. So you can see this is a really big negative cash flow because basically Apple is buying back its shares crazy high, more than $70 billion, $76 billion to be exact. And also you can see here that the dividends that Apple paid, looks like Apple paid $14 billion of dividends. And so you can see that the cash flow and financing is negative 86 billion, and most of which comes from repurchase of common stocks. And you can see here net change in cash basically is cash decreased by $17 billion. And you can see some supplemental items here that cash interest paid. Company paid $3.1 billion of interest. Taxes paid cash $11.8 billion. And you can see that levered and unlevered free cash flow. And you can see that the company generated $52 to $54 billion, depending on levered or unlevered free cash flow. And again, if you don't know something's meaning, I just want to point out this again. Let's say if you don't know anything about levered or unlevered free cash flow, what you can do is go back to Capital IQ and then go to cash flow statement. And then you can scroll down and you can see here levered free cash flow. So if you click on that information tab right here, it will tell you levered free cash flow is supplemental item, blah, blah. And there it has following components. You can see how it's calculated: EBIT times 1 minus statutory rate for tax rate. And statutory rate is 37.5%. This has to change to 21% if you are using this number, because new tax code is different. And basically it adds back up to interest expenses times 1 minus the tax rate, and then depreciation is added because non-cash expenditure. You can see amortization is also added. Capital expenditure should be subtracted, or in other words, if it's a negative number, you can add it up. You can see tangible, intangible assets, and you can see total stock-based compensation and change in net working capital. Okay. Okay. All components of levered free cash flow are stored and used to input with a positive sign indicating profit, and or cash inflow with a negative sign indicating loss or outflow. If you look at unlevered free cash flow, you can see here, I can put it right next to each other, and you can see that here there is no interest rate tax shield effect, right? So here you can see the tax shield effect of interest rate, versus here you don't have that benefit. So basically levered free cash flow will give better performance results if a company is highly levered with debt and make profit out of it, versus you can eliminate that effect. If you want to be more fair to eliminate the impact of interest rates, you may want to use unlevered free cash flow. Okay, so if let's say if you look at let's say we assume that we want to use levered free cash flow. Okay, you can see here it's $52.2 billion. And yeah, that's pretty much it. If you do a recap for cash flow statements, I think it's important to understand that there are three sources. One, cash from operations, which is $80 billion for Apple. Two, cash from investing activities, which is negative $10.6 billion for Apple. Three, cash flow from financing, which is negative $86 billion for Apple. And if you go dive into cash flow operations, basically the biggest component here is net income the company generated, plus depreciation amortization, since it's not a real cash flow, and then some other changes in, again, in receivables, inventories, and so on. If you dive deep into cash flow from investing, the biggest component for Apple looks like capital expenditures that we invest, and these are long-term investments. And if you look at cash flow from financing components, total debt issued is positive 22.7, total debt paid, which is 19.8 billion negative cash flow. And you can see for Apple's very big number of repurchase of common stocks. As long as, and also dividends are important, which company paid $14 billion. As long as you know this and understand that levered and unlevered cash flow for the company, free cash flow, I think you will get most out of cash flow statements. That's it for this video. Until next video, enjoy valuations.